Welcome, everyone, to another exciting episode of our podcast, CRE Exchange. I'm Aviva Fink, your host and the Vice President of Global Marketing at Altus Group, a leader in asset and fund level intelligence. I'm joined by Omar Eltorai, our U.S. Director of Research, and together we'll share the latest news and trends in U.S. commercial real estate markets, the topics that have caught our attention. And in this week's episode, we'll be discussing some interesting retrospectives that our research team has been leading, thinking about kind of current state of affairs and whether or not history has a way of repeating itself. And with that, Omar, welcome to today's show.
Thank you for having me.
Always a pleasure. And I guess we'll start with a topic that we have talked about really since the podcast has kicked off, and that's the state of current things. And as I mentioned in the opening, I think there's an opportunity to say that we are perhaps learning from history or able to lean on history to have a better sense of what has been transpiring. But starting with maybe the current state of affairs, where are we in the cycle? What's been happening that makes us take a look back in time to see what historical trends we can lean on?
Certainly. So it's absolutely an exciting time. And that is largely because the cost of risk has been changing pretty dramatically. This started in 2022 when the Federal Reserve, as well as many other global central banks, really were making a significant effort to tame inflation, which was caused by a lot of the excess liquidity that was pumped into the economy during the pandemic and coming out of the pandemic. And so as the central banks raised rates, this came with many repercussions that have really reverberated across the capital markets and put pressure on many firms, especially the banks and other financial institutions that ultimately have to reprice their assets. And the cost of capital has a major implication on how they really run their business.
So just to make sure that I fully understand, so the period that we're living in is really a time where there's been a tightening and then maybe a retreat of traditional lenders or banks specifically from commercial real estate, given the risk associated potentially with their commercial real estate loan portfolios and also the cost of capital.
Absolutely. And what we saw at the very start of the tightening, or as interest rates started rising, is that banks began pulling back. And so they pull back by tightening their underwriting standards. So that is often either shifting the criteria to which they originate loans, but also pulling back in the sense that they are no longer allocating capital to certain exposures that they don't want to have as much of. And so that could be to corporates and industrials, that could be to consumers, that could be to commercial real estate in this case. And so we saw them starting really to tighten their underwriting standards, but then also raising the cost of the new loans that they were originating.
And part of that, does that tie into some of the bank, I guess, failures? I wish there was a more euphemistic way of saying that, of early 23.
Yeah, absolutely. So the banking troubles that really started in March of this year and seemingly are still playing out, but getting maybe fewer headlines, is really an example of the added pressure that the rate hikes, or the overall tightening phase of the cycle has put on these institutions.
Mhm. And this is what we talk about: unprecedented uncertainty. There are a lot of words thrown around in industry about just how we don't know. There's a lot we don't know. But because of that, I think the research team at Altus took a look at really modern history. So let's say 20th century, and what do we know? And what is this most akin to in our recent past, or what can we learn from that? And in that research, where did you land? Which financial crisis or reset does this seem most similar to?
Sure. When people hear of bank failures, or I would say bank stress, it is often too easy to jump back to the global financial crisis. However, I think that you have to look a little bit further back to find a level of distress or just pressure in the financial system that is much more similar to what we're seeing now. And the period that I think is most applicable, or there are more similarities to now, is really the savings and loans crisis that took place, started really in the 80s, but ran through the 90s. And the reason I would say that the S&L crisis is probably more representative of the current period as opposed to the GFC is because the GFC really brought the entire financial system into question and was something that you're not seeing that same type of shock
Mhm.
that
We're all very
it's,
grateful for that.
yeah, yeah, I don't think GFC 2.0 is really in the cards, at least in the coming years. But the savings and loans crisis seems to have a lot more similarities that seem reasonable and potentially applicable to the current environment.
I'd say some of our listeners, they probably lived and worked through that period. And for others, they think about the S&L crisis as something that they remember hearing about. Maybe they studied for it in a test. So maybe just a little refresher on what happened during the S&L crisis.
Sure. So in the 70s and early 80s, you had a macro environment that could be very much characterized by very high and volatile inflation, as well as central bank tightening or rate movements that were also volatile and very high. It really shocked financial institutions that existed in the US, and they were called savings and loans institutions, or also referred to as thrifts. But these have really been around since the 1800s. They are uh, predominantly depositor funded, and they focused almost exclusively on real estate lending. Initially, they were focused on really only residential lending, but the idea was that a local community would be able to deposit their funds. So they had a safe place to put their money and earn some interest on it, and could also then borrow against those deposits or the pooled deposits to form households to really fulfill the American dream. So when you hit this period of high inflation and then Fed rate hikes that were trying to tame that inflation, it ultimately made it so there was a mismatch in terms of assets and liabilities at these institutions because the rate at which they were paying for deposits was insufficient to really keep up with the competitive rates that the depositors could find either in money markets or pretty much anywhere else. At the time, deposit rates they were regulatorily capped, and so it forced a lot of these S&Ls into a situation where they were seeing this outflow of deposits, and yet they weren't earning enough on their loans because as interest rates go up, their earnings look less, and so they were accumulating more and more losses. So that was really the 70s to the 80s. You started seeing these losses accumulate at a lot of these savings and loans institutions, and many of them became effectively insolvent. However, there were over 4,000 of these across the US. And so the magnitude of the problem was too great for any regulator to really step in and to really ensure the system and the soundness of the system. And so what the regulators did at the time was they effectively allowed many of these institutions, even though they were insolvent, to keep operating. And then in 1982, legislation was passed to really unharness these institutions so that they could start lending into a broader area of loans. So they could originate loans that could generate higher yields. So the hope was that they would be able to grow out of this.
Recover
Um,
themselves.
exactly. And so when the 1982 Garn-Saint-Germain Act was signed, ultimately that meant that federally regulated S&Ls or thrifts could start making all of these new types of loans. And so they really took advantage of that and they started lending to riskier and riskier loans because they were ultimately trying to make up for the losses that they had accumulated. That resulted in a period of really rapid growth. So you had from 1982 to 85, you had the savings and loans balance sheets grow by 50%. Now, for comparison, banks at the time really only grew by around 25%.
Wrong.
So this was a real boom for the savings and loans institutions. However, there's no free lunch, and many of these loans that they originated started going bad. And that meant that we not only were not really helping the earnings of these institutions to offset the losses that they had built up, but this was just adding to the losses. And so ultimately, you had in a single year in the late 80s, I think it was 88, you had 750 of these institutions essentially fail, right? There was a full overhaul of the regulatory system and the oversight. So the supervision, FDIC was set up, as well as there was we would probably call it a bad bank now, but it was called the Resolution Trust Corporation. And so this was a asset manager that was brought into existence by legislation, and it took the balance sheets of these failed institutions and had to deal with them. Now,
And
I think
maybe before you carry this story forward, I'm just trying to tie the pieces together a little bit. SNL versus present day, and just even thinking about asset versus loss and that balance there. That strikes a chord in terms of thinking about present day, where you had what seemed to be healthy lending policies and investment strategies, but then as interest rates changed and as valuations change, it's well, are your books balanced, right? And is that kind of a fair way to connect SNL to present day where it really comes down to basic accounting, right? Like it's just how much have you lent out? How much are people trying to take out? And how much is your book worth?
yeah. So I think one of the most obvious similarities is while the risk management of the SNLs was fine until things changed. That is the same thing that really happened earlier this year, where you started to see a number of either bank failures or some forced sales that took place. And I would say uh, recently, we've seen more forced sales of these institutions that either get bought out fully or you see large loan portfolio sales.
So I guess what maybe bit of silver lining there is it doesn't look like we've repeated some of the mistakes trying to solve for the SNL crisis by just people relaxing their lending standards, right? Instead, it's almost the reverse. It's we're tightening, we're getting smarter. Does that seem to be a learning from previous approaches?
Absolutely. I think that while cycles do see similarities, every cycle that we go through is unique. When we have the fortune of looking back, things look obvious, but when you're going through it, ultimately you are seeing that there are differences. So we're not necessarily repeating the past, we're finding new ways of going through similar cycles.
And so going back to SNL, then how did we resolve some of that lack of function in the lending space, in the credit space?
Yeah. So when RTC took on the assets, they started to really try to tap the private markets and effectively investors to be able to redistribute the risk, but also at a new price that makes sense, that makes investors actually want to buy the assets. They had a number of vehicles that they launched. However, their mortgage trusts, which now we'll refer to them as like CMBS, they launched multiple series and helped establish CMBS market. Even though the CMBS market was born in 85, the issuance and overall volume of transactions was a super niche market. It wasn't a known marketplace. And so when RTC started coming out with their N and S series issuances from 1990 through 95, this helped establish an appetite for and standardization of CMBS issuance. And a lot of that is actually still around today. But
Sorry to interject again, but are we seeing CMBS issuance on the rise now as well? Or is this an area where we see
yes,
a divergent approach?
yeah. So while CMBS is a known market, and I would say that the second quarter we saw a significant uptick of quarter over quarter, overall issuance is down pretty
Mhm.
significantly compared to 2022 and 2021. But I don't think anybody is questioning the CMBS market as a whole. It's just a matter of time before new issuance does come out. But this is one of the silver linings to the S&L crisis. It not only helped highlight important risk management practices, it shaped a huge portion of our modern financial institution regulatory system, but it also really created and solidified investor appetite for mortgage trusts in the CMBS market, which ultimately serves a significant role in financing commercial real estate today.
So it's one of the interesting things I think that just going through the history of SNL with you is, or SNL crisis rather, is that there are, as part of the recovery, there are a lot of gains for us as a financial system, whether it's regulatory, it's new financial instruments or financial products, and we like get smarter and get better. So thinking about where we are in the current cycle, what are things that are shifting and some of the changes that are being discussed that may turn out, and this is granted hypothesis now, but may turn out to help reshape or refocus the financial economy?
Yeah. So I think one of the big shifts that's happening is that the non-bank lenders are very present and are really on deck to start playing a bigger role. And non-bank lenders can be everything from insurance companies, which they have played a historically large role in mortgage financing, REITs, but also the debt funds. So we've seen significant fundraising for and interest in debt funds, and they have the ability to move pretty quickly, but also they can be highly selective. They're much more nimble than many of these deposit taking and heavily regulated institutions. But one thing that we may see that is a bit different from S&L crisis is that this is an opportunity potentially for these debt funds to play a more significant role in the commercial real estate lending space.
Mhm. Interesting. What about on the regulatory side? So aside from maybe not newcomers, but like a new concentration of debt funds or non-bank lenders taking on more CRE debt, any changes that we are or you're tracking on the regulatory side?
Yes. So regulation is interesting because there are elements that are political. It tends to move slowly, but it also can have major impacts to really reshape the industry as a whole. And there has been, and this is not new, but there has been regulatory bodies, whether it's FSOC, which is a financial stability oversight council, which is a group of multiple regulators that really comes up with kind of guidance for and principles for the different market regulators to follow. They have raised concern around what they classify as shadow banking. So this is pretty much the growth of non-bank lenders. We haven't seen anything, I would say, massively impactful come out, but being that it's been on their radar since before the most recent banking woes happened in March, this is something that I don't think it's falling off their radar at all. I would expect in the coming years, we might see more developments there. But in the meantime, I do think that the regulated institutions, so predominantly the banks, have been getting more and more, whether it's scrutiny or attention, to have more higher quality capital, as well as their examiners are getting more and more in the weeds with the institutions that they are responsible for. So I think there's growing pressure on both sides. However, I'd say the screws are being tightened much faster for the banks.
Interesting. And I know we're coming up close to time. So, for members of our audience who are interested in learning more about the comparison between history and present day, specifically the S&L crisis and current dynamics at play, where can they go for access to information?
Yes, our research team will be coming out with a article shortly that does compare the crises. This was written by our senior market analyst, Cole Perry, who really goes through the S&L crisis and how it compares to today. And so I would say go to our site and look at our Insight article, or feel free to reach out.
All right, excellent. And yes, for those who are listening, you'll see it linked in the details of the podcast once the article is live. And with that, Omar, it's been such a pleasure to have you again on our podcast. I look forward to our next conversation where we get to pick up on more recent current events and some reflections on them. And yeah, to our audience, thank you for tuning in. We look forward to continuing to share our insights and research with you. Hope you all have a wonderful day.